Hello students, today's live lesson will cover selected important topics from Lesson 7. Please excuse my voice as I'm a little nasally due to having a cold. The learning objectives of each lesson are a useful tool to ensure comprehension of key concepts. First, let's briefly review the learning objectives of Lesson 7. After completing this lesson, you should be able to describe the characteristics and functions of money, describe the different kinds of financial institutions that make up the financial system, explain the function, structure, and tools of the Federal Reserve System, identify issues related to international banking, and explain the types and characteristics of different financial investments. I will be reviewing the characteristics and functions of money, the different kinds of financial institutions that make up the U.S. financial system, and some issues related to international banking. Modern money generally takes the form of stamped metal or printed paper issued by governments. Money should be portable, divisible, durable, and stable. Portability refers to currency that is light and easy to handle. Divisibility means that it can be easily divided into smaller parts with fixed values. Durability refers to the fact in which modern money does not spoil and is hard to counterfeit. Stability simply means that the value is predictable. Now we discuss the functions of money. In a barter economy, goods are exchanged directly for one another. In a money economy, the money is exchanged for goods. The first function that money serves is a medium of exchange. Money is used to buy and sell things. Second, money is a store of value. This means that money can be used for future purchases and stores value. Third, money is a measure of worth, since all products can be valued and accounted for in terms of money. Now let's describe money supplies. When the money supply is high, the value of money drops. When it is low, that value increases. M1 counts only the most liquid or spendable forms of money. Currency or cash includes paper money and metal coins issued by the government and is widely used for small exchanges. A check is an order instructing a bank to pay a given sum to a payee. Checking accounts are money because their funds may be withdrawn at any time on demand. These are all non-interest-bearing or low-interest-bearing forms of money. M2 is another measure of money supply used by businesses and government agencies. M1 includes M2 as well as time deposits, money market mutual funds, and savings accounts. A time deposit, such as a certificate of deposit, has a fixed term, is intended to be held into maturity, cannot be transferred by check, and pays higher interest rates than checking accounts. A money market mutual fund occurs when an investment company buys a collection of short-term, low-risk financial securities. M2 is now the most reliable indicator of a country's economic status. The next topic will be how different financial institutions create money. The four financial institutions that we will discuss are commercial banks, saving institutions, credit unions, and non-deposit institutions. Federally insured commercial banks accept deposits, make loans, earn profits, and pay interest and dividends. Bank liabilities include checking accounts and savings accounts. A saving institution includes mutual savings banks and savings and loan associations. They are also called thrift institutions because they were established decades ago to promote the idea of saving among the general population. A credit union is a non-profit, cooperative financial institution owned and run by its members. Its purpose is to promote thrift, careful management of one's money or resources, and to provide members with a safe place to save and borrow at reasonable rates. Each credit union decides whom it will serve, such as a group of employees, people in a particular community, or members of an association. A non-deposit institution uses inflowing funds for purposes other than earning interest for depositors. Four of the most important are pension funds, insurance companies, financial companies, and security investment dealers. A pension fund is a pool of funds that is managed to provide retirement income for its members. There are public pension funds, such as Social Security, and private pension funds. Insurance companies accumulate money from premiums charged for coverage. They invest these funds in stocks, real estate, and other assets, which help to pay them out automobile damage and healthcare expenses. Financial companies specialize in making loans to businesses and consumers, such as a mortgage refinance. A securities investment dealer buys and sells stocks and bonds for client investors. An example is Merrill Lynch. Here is a wonderful video that summarizes the main topics of money and finance. The video also addresses the issue of Bitcoin, which is a relatively new type of currency. Our final topic for today's live lesson will be international banking and finance. We will cover currency exchange rates, the international payment process, and international banking structure. Every currency's value changes, reflecting global supply and demand. The exchange rate is the value of one's currency compared to the value of another. At any one time, some currencies are strong, selling at a higher price and worth more, while others are weak. The textbook example on page 404 explains that if the euro is stronger in relation to the US dollar, the European vacation you might take could be more expensive if you are US-based. A French family, on the other hand, would be more inclined to visit the United States on vacation then, because they could get more for their money. Currency value is influenced by bank policies. As the Federal Reserve maintains low interest rates, the dollar weakened. Financial settlements between buyers and sellers in different countries are simplified by services provided by banks. Since there is no worldwide banking system, worldwide banking stability relies on a loose structure of agreements between individual countries or groups of countries. There are two United Nations agencies that help to finance international trade, the World Bank and the International Monetary Fund. The IMF is a group of about 150 nations that have combined resources to complete the following: promote the stability of exchange rates, provide temporary short-term loans to member countries, encourage members to cooperate on international monetary issues, and encourage the development of a system for international payments. I have created a small Check Your Understanding section, similar to the online presentations, to help you verify your comprehension. You can review your answers in the next slide. Thank you very much for watching today's video. Please reach out to me via the chat room or email if you have questions. Have a wonderful day.